Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, February 21st, and then we'll see how things look for Wednesday, February 22nd. We had a pretty decided down day. We were down 2% with the S&P. We broke through some more support. Some of our short-term indicators are becoming oversold. We have no overbought indicators right now. Things are really switching much more negative. And on a one-day basis, we have to ask, did we overdo it? So let's go back and talk about what happened. Right at the open, we had a gap lower open. The futures were negative during the night, down 0.5% to 0.75%, but then things really picked up right after the market opened. We gapped lower and we dropped below S1 right off the bat at 40.58. Which is interesting because this was a pivot level for Friday's session. We also then dropped below S2 at 40.36. As the day kept going, prices just kept going down and down. We actually went down to S3 at 4,002, so you can kind of call that the 4,000 level, and we closed right at the low. We were down 2% on the day. Volume was still below average. It picked up slightly, but not very much. And our technicals have now gone over to looking negative. We have inflation and interest rates. What's being blamed a lot for the downturn in Monday's session is more geopolitical. And I'll go through some of the statements that were made and some bullet points that address that. Here's the intraday chart showing how we gapped lower below S1. Never even saw that during the whole day. Went blazing through S2 all the way down to S3, dropped below that a little bit, then trailed up and down, and ended up closing pretty much at the low for the day. So some comments that we can make. The S&P closed just below 4,000. We're kind of calling it the 4,000 level. And the Dow is now down for the year. All the gains that it had going back to the beginning of 2023 are now gone. There was a report over the weekend in the Wall Street Journal that said that China's President Xi, he may go to Moscow in either April or May to try to encourage peace talks. That's more on the happy side. Then there were some other reports that came out saying that China is considering providing lethal assistance to Russia. That could really escalate things big time if that ends up happening. And then on another negative note, Putin came out and said that Russia is suspending their participation in the New START nuclear treaty. So that's never a good thing. These treaties are designed to limit nuclear buildup, and the fact that Russia is not participating in that could be taken as much more negative, and the market reacted to that. Growth declined less than value. That's more on the positive side. They were both down, but growth did fare better in Tuesday's session. On a short-term basis, we have our McClellan oscillator, the stochastics, the Stoch RSI, the Williams percent R, and the force index. They're all extreme negative right now, so they're giving us some oversold conditions. On an intermediate term basis, we have the CCI 14 and 20 are both extreme negative. The dollar was up and interest rates were also up, and both of these probably didn't help the overall stock environment. We still have all of our yield curves that remain inverted. Sentiment did drop a little bit, but it's still positive. We went from 69 down to 63. I'll go over the economic reports on the next slide. Our trend is now switched over to negative. The red line has crossed above the green line, but the ADX itself is continuing to weaken. However, we're still above 20, so we're in a trending environment, but it's a weakening trend, and we've just switched negative. Our bias, which just looks at one day, more or less, is still negative, and our momentum, which looks at the last 2, 3, 4, 5 days, or just takes them as a group together to get a consensus, I'm keeping that at negative. The economic reports that came out, we had the IHS Market Manufacturing PMI. This was the preliminary report, not really market moving. It came in below 50, so that's showing contraction at 47.8. It's up a little bit from last month where we saw 46.9. And the services PMI came out at 50.5. That's actually a little above 50. So it's showing a slight expansion of the economy. And the last time we had the report, it was at 46.8. Existing home sales were weaker than expected at 4 million. They expected it to come in at 4.12 million. The last time we had the report, it was at 4.03 million. Here's a chart that I found on Twitter over the weekend just to show you something interesting. I'm hearing conflicting information, and when I do that, I tend to look at charts. Some folks are saying that U.S. consumers still doing okay. There's money in the bank. They haven't spent all their stimulus money. That money's just waiting on the sidelines. It can be put to use if necessary. I heard that in a podcast over the weekend. Well, this totally contradicts that, where it's showing that the savings rate is the green line and it's going down, and credit card debt is massively going up. And I tend to favor looking at charts instead of just some kind of conclusions that folks say. I want to look at actual numbers and see the trends of those numbers over time, but that's just me. Getting back to looking at the market, the Ulcer Index did tick up a little bit. We're still below this moving average, but fear is starting to come back into the market, and we're seeing that more with the VIX, where it really went up and closed higher on the line chart, and we're back up into the 22 range on the bar chart, and we're seeing a little pickup with the VIX of the VIX, how it ticked up with the bar chart and on the line chart. Here's the ADX, which we use to define our trend. It's weakening because it's below the moving average. The green line had been on top, but it's been declining with the red line going up, and they're just crossing right now. So we're switching that over to a negative trend. Now, because we went down 2% in one session, there's always the likelihood of some kind of a rebound in Wednesday's session. We can't ever take that off the table. If that happens, that might push the green line back on top. We don't really know that for sure until after Wednesday's session, just how this is going to recalculate. But that's just something to be aware of. This is not a mature trend. This would be the very beginning of a trend. Looking at the daily chart, we broke through a lot of support where we had already broken through the December highs. Now we broke through some other support levels. We're coming back down to this pivot level. So far, that's underneath the current price range. That may provide some kind of support, and we're still above the 50 and 200-day moving averages. Down on the bottom, we see where volume continues to be below average. This is what I'm talking about. From Friday to Tuesday, the advanced decline ratio went extreme negative. Now, it doesn't mean we're going to go in the other direction. It just might mean that we slow down a little bit in Wednesday's session if we do continue to fall. The stochastics, after being extreme positive not very long ago, have now shot extreme negative in the short term. We're getting more negative in the intermediate short term, and we're no longer extreme positive in the long short term. So these charts are really touchy. All of them together are still short term. We just keep an eye on this to see when we've gone down a little too far, too fast. The Stoch RSI, also a very touchy indicator, has remained extreme negative. Williams percent R, extreme negative, and the force index went down pretty fast, and we're hitting the lower end of this Keltner band. CCI 14, extreme negative, and CCI 20s just going into extreme negative territory. All of our oscillators have now flipped over negative. Short, intermediate, long-term, even the TRIX and the KST have now crossed over their moving averages. The PMO is negative. It switched a few days back, where even a few days before that, we saw the indicator based on price and volume cross over negative. Our PMO study starting to get extreme negative with the PMOs that are rising, declining with the buy signals, and now declining with those PMOs that are above zero. Swollen Trading Oscillator, after having been above the zero line based on price and volume, has now crossed below for each indicator. Bullish percent index, as we're starting to drop down a little bit, we're seeing this really pick up. As long as it stays above 50, that's considered positive, but look at the direction that we're going. So this is turning more negative. The NYSE bullish percent index, after breaking out and coming back down, we're starting to come back down to the previous levels. Chaikin money flow still holding up okay. It did decline, but we have some pretty hefty green bars. And the vortex is now crossing over negative. The red line's going above the green line. TTM squeeze getting set to possibly go negative. We see these darker blue bars continue to go down. This will probably cross below zero very soon if we see follow-through weakness. The go-no-go system is still back to neutral. And our CMB composite is getting extreme negative. The Renko has just added a red box that is negative, and 3-line break has a black bar, and that is negative. We're seeing 3 zeros drawn in the point and figure chart and a new signal called a bull trap, which was registered in Tuesday's session. It looked like we were breaking out, and now we're going right back down. On a short-term level, we did break through this Fibonacci level at 4,007. Longer term, we also broke through to this 38.2% retracement level at about the 39.99 level. Call it 4,000. On the longer-term Fib chart, we're coming back down to this 38.2 retracement. If you round it up, it's at about 4,000. Here's a much longer Fibonacci chart going from the COVID low to the all-time high. We broke down through this 40-20 level. As the market was open on Tuesday, this is the level that I was watching, and we just sliced right through that without any problem. So now we're in a different area of no man's land according to this chart. Moving averages starting to come back down inside of some of the moving averages, and that's more negative. The elder impulse for the S&P continues to be negative, and we're coming down to this 65-period exponential moving average, which may end up providing support, or we might slice through that. McClellan oscillator starting to get extreme negative. The summation index based on price and volume are both declining. Not seeing a real breakdown yet in the new lows. Of course, we didn't see any new highs either, so this continues to go sideways with our 5-period measure, and our 10-period is still slightly declining. The advanced decline line did take a bit of a hit, and we're seeing an extreme reading. You see this really big red bar, both based on price, not quite as big based on volume, but we saw some weakness with both price and volume. We're dropping below the zero line with our advanced decline ratio with both the 19 and 39-day exponential moving averages. Accumulation distribution is still positive but showing some weakness. We're well above this moving average, but if we continue to fall, we will drop below that. Volume still continues to taper off. The S&P to utilities ratio continues to fall, which when we spike and start coming back down, that often marks a top of some sort in the S&P 500. With our 20-period simple moving average of the open, high, low, close, we've broken down below all of these different moving averages. The Dow, after having been slightly above the pivot level, fell back down below it, and now we're down to S1. The diamonds are negative. Small caps, after coming up to this R1 level, came down, looked like they were rebounding, and then had a pretty bad day. Here's another small cap index where we came up to this resistance level, came back down. It looks like we were bouncing off support. We came back down and closed below that support level, so that's more negative. On top, we have the RSI, which is declined below 50, and we have a declining MACD on the bottom. The mid-caps, after hitting R1 and coming back down, still are showing some more weakness. The NASDAQ also hitting overhead resistance and now coming back down. NASDAQ 100, the same story, hit resistance, coming down. The Qs are negative. The NASDAQ 100 going from the all-time high back down to the October low, came up to this 38.2% retracement and are now declining. The Pring bottom fisher continues to generate a buy signal. And the home builders are pretty much going hand in hand with the S&P 500. The S&P is down, home builders were down, the ratio was down, the correlation is moving back up. Treasury bond prices for the 7 to 10 year prices continue to decline. We're below 50 with the RSI, and we have a declining MACD, where yields are going in the opposite direction after coming down to the 200-day simple moving average, have bounced up off of that as rates continue to go up. With our bonds to investment grade bonds ratio, we're starting to show where fear is coming back into the market. Looking at our possible positive scenarios, nothing really to latch onto other than what has shifted more negative. We've declined below zero based on price and volume with our 19-day exponential moving average of the advanced decline ratio for the S&P. The Treasury yield spike looks like it's getting taken out on this chart. And our staples to S&P 500 ratio is still looking like a viable spike, but this is really going back up. What's our outlook for Wednesday? The technicals are negative. We switched to a flat-out negative stance. We have a weekly MBA mortgage application index coming out, and the FOMC meeting minutes will be coming out. That's at 2 p.m. Eastern. Then the Russia-Ukraine situation, I've also attached China to this just because they're now talking about doing things, but that could escalate things and would not necessarily be a positive thing for the stock market. But the markets are still fixated on inflation and interest rates. The Stock Traders Almanac statistics for February 22nd, the Dow is neutral to slightly positive. It's up 52.4% of the time. Where the S&P is negative, it's only up 38.1% of the time, and the NASDAQ is negative at being up 42.9% of the time. I don't read through this in every video because it would just be redundant. We will be getting some Fed speak on Friday. As far as our scenarios for Wednesday, we're going with the down scenario right now. There's a lot of headwinds hitting the market, and those are starting to bear themselves out based on price. But because we overdid it, we would not necessarily be surprised if the market makes some kind of attempt at this 4,000 level to rebound. But our technicals are negative, and we are now in a negative trend. So we can't go with the up scenario, and we're not going with the sideways because the ADX, even though it's weakening, it's still above 20. It's declining, but it is crossing over negative. Our conclusion, the S&P is negative, short-term negative, intermediate-term negative, long-term we're still positive as long as we remain above the 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.